Welcome back to Road to Fire. We're a family of three documenting our journey to FIRE, financial independence, retire early. Let's chat about our top 5 Vanguard ETFs to help us reach FIRE. I will share details on each fund, rates of return, and why we have this in our current strategy with honorable numbers like always, so please hang with me. Now, ETFs are the best investing vehicles to build long-term wealth. Keyword is wealth. ETFs are not designed to make you rich overnight. For us, as we pursue FIRE, we are focusing on long-term and generational wealth. Now, this is obviously my opinion and not financial advice, but if you're new to investing, an ETF is a great place to start. But just for a bit of history here, ETFs are not new. The first one hit the market in the 90s, but I didn't learn about ETFs until recently. And when I say recently, I mean like 2-ish years ago. I feel for me, that's basically a theme. But I focused 100% on index funds, which are still awesome, but do come with barriers and some limitations. I've grown to love ETFs more as it's a great way to get your foot in the door as a new investor without the high minimum entry fee for an index fund. Okay, what is an ETF? An exchange-traded fund, ETFs, are funds that pull together the money of many investors to invest in a basket of securities that can include stocks, bonds, commodities, and so forth. An ETF can be structured to track anything from the price of an individual commodity or to a large and diverse collection of securities. Think of an ETF as a bouquet of securities that all act like a single stock. ETFs are commonly mistaken for mutual funds or index funds. At a first glance, ETFs can look quite similar to mutual funds, but the big difference between the two is how they're priced and traded. ETFs are actually a lot like stocks. That's because they're traded on an exchange. Since they can be bought and sold throughout the day, their price may fluctuate more often. But mutual funds, on the other hand, are only priced once per day after the market closes. So why buy an ETF versus an individual stock? The number one reason is diversification. An ETF gives you a pool of securities, and typically, the more diverse you are across holdings in your portfolio, the more balanced your investments will remain, even during market volatility. Not always, but typically. Number 2 is the flexibility or liquidity. While trading mutual funds are bought and sold at the close of business each trading day, investors can trade ETFs at any day throughout the day from market open to market close because an ETF acts very similar to a stock. And the best thing about ETFs is their lower fees. As you build long-term wealth, these quote-unquote tiny fees will tend to add up. ETFs traditionally have lower expense ratios or costs to manage and operate than actively managed mutual funds because ETFs are passively managed. But check with your brokerage account to understand if you're getting the best fees for your ETFs. But one minor disadvantage of an ETF is to make sure that your overall portfolio is balanced. Now, I made an entire video on asset allocation that I will link here, but I did outline a great rule of thumb on how to weight your portfolio for long-term wealth. But honestly, you can't go wrong with an ETF. Now, our top 5 ETFs are based on our long-term goals. We hold these ETFs, not all, but most, in either an ETF or index fund. To better understand what ETFs works best for you, you need to understand your risk level, timeline, and then calculate your FIRE number. The ETFs we invest in align with our goal of retiring in 8-ish years with a $2.45 million FIRE number or about $1.9 million invested into the market. Now, we are working towards getting FIRE before 40, but that might be different for you. There isn't a one-size-fits-all for investing. In fact, don't pick the same investments we've picked. Do your own research and evaluate what ETFs works best for your goals. Ally has done a great job creating an ETF 101 document, and I'll link that below in the description box if you want to get into the details. Disclaimer, I'm not a financial advisor, and this video is intended for entertainment purposes only and holds only my friendly thoughts and opinions. But if you're looking to make adjustments to your investments, consult with a financial advisor. Okay, in my opinion, let's start with the best ETF out there, Vanguard's VTI. VTI is one of the largest ETFs available. It's perfect for new investors because it's diversified and its expense ratios are extremely low, which becomes so important as your portfolio grows over time. The ETF provides exposure to the entire U.S. stock market, including small, mid, and large cap stocks. This is probably the least riskiest ETF out of all the 5 I will talk about today. And honestly, with this ETF, you get a piece of almost everything. Fast facts here. Its 5-year rate of return is 17.9%, which is so amazing. Its expense ratio is very low at 0.03%. It's classified as U.S. domestic stocks, obviously, and the current price is $226.43. And with this ETF, you get the best the US has to offer. The top 22% holdings are listed here, including trillion and multi-billion dollar companies such as Apple, Amazon, Facebook, Tesla, JP Morgan, J&J, and so forth. Trusted companies, you just can't go wrong with VTI. Now, you can seriously build a portfolio with just VTI. If you are someone looking for simplicity, this ETF alone can provide you with it. Because of its vast diversification, you are essentially investing in almost every sector in a perfectly weighted single ETF. Now, VTI follows the US market, so it's a great way to start your investing journey. Although I personally see this investment as lower risk than other ETFs, Vanguard has classified this as a 4 out of 5 for risk level. So when building your portfolio, it's very important to outline what is your individual risk level. And as personal finance is personal, so is your risk level. We tend to be about 3 or 4 out of 5 when it comes to risk level, and that has been slowly inching up higher over the years. I know there are investing risk quizzes you can take online to better understand your personal risk level when it comes to investing. But number 2 is also a fan favorite, Vanguard's VU. This fund tracks the S&P 500 index, which means it holds securities from 500 of the largest U.S. companies. So this index has the same top selection from VTI. I can see the appeal with VU as this includes all of the U.S.'s most elite and stable companies for the most part. But because there is a strong overlap between VU and VTI, I personally won't have both in my portfolio. Fast facts here. The 5-year rate of return was 17.6%, which is still great, but slightly lower than VTI. Expense ratio is 0.03% again. It's still classified as U.S. domestic stock, and the current price when I pulled this was $401.80. It definitely has probably changed since then. Top holdings are identical to VTI as expected, but weighted slightly higher at 27.3% in this ETF. So one can say that this ETF is slightly more riskier as it's less diverse than VTI, but I think they are fairly comparable. So which ETF performed higher than VTI and VU in the last 5 years? Number 3 is Vanguard's Growth ETF, VUG. This fund seeks to track the performance of the U.S. Large Cap Growth Index, and no single security has more than a 10% share. This ETF follows U.S. companies with the most potential growth in the near future. Fast facts. The 5-year rate of return was 23.05%, which is just unbelievable. The expense rate was a bit higher at 0.04%. It's still classified as U.S. stocks, and the current price is just under $294. So the portfolio composition is as expected, with almost all the FANG stocks leading in the top minus Netflix. New adds from this ETF versus the other is Visa, Home Depot, and MasterCard. But I can definitely see a portfolio that has VUG and not VTI or VU, as this ETF has very similar composition overall, but with higher potential returns in the long term, that does come with a bit more risk. In my opinion, you can't go wrong with these 3 ETFs. All 3 ETFs provide you with low expense ratios, strong returns, and a solid diversified portfolio within the U.S. market. In our portfolio, we have VTSAX, which is the index fund of VTI. VTSAX is basically in the How to Reach FIRE starter pack on every podcast, book, or article I've ever read about FIRE. Specifically, when I read The Simple Path to Wealth, I began to see the benefits of having a very simple, almost minimalistic investment portfolio across all of our accounts. Right now, we probably have VTSAX in all of our accounts because when I first started learning about FIRE, I only heard about index funds and not the more sexier ETFs. The biggest problem I see with Vanguard's index funds is the minimum account requirement. Most start at about $3,000 and go upwards to $100,000 just to get in. And as a new investor, you are probably not starting out with a few $1,000s to invest. That's why ETFs is a great way to get your feet wet with investing. All right, if you've been here for a while, then you know I got the dividends bug. And I'm all about dividends and free money. Number 4 is Vanguard's High Dividend Yield ETF, VYM. Dividends is when a company pays its shareholders, or you, a portion of its profits just to keep you happy. Isn't that nice of them? But the benefits of dividends is the compound effect long term. Fun facts. The 5-year rate of return is 11.43%, which is definitely lower than the 3 previous ETFs, but does provide you with an additional stream of income. It also has a higher expense ratio at 0.06%. It's still classified as domestic or U.S. stocks, and currently it is priced at $104.83. Here are the top holdings that represent about a quarter of the ETF. P&G, Bank of America, Comcast, Exxon, Verizon, Intel, and Cisco are newcomers to the top 10 list as they pay consistent dividends over time and are stable companies. We definitely have a dividend-paying index fund in our taxable brokerage account right now. We really started funding this heavily last year, and overall we bring in about $300 a month in dividends, which are all currently reinvested, but will be great once we hit FIRE. So number 5, and probably the most overlooked, provides you with international exposure, is Vanguard's Total International ETF VXUS. This fund tracks the performance of the FTSE Global All Cap ex-US Index, which measures the investment return of stocks issued by companies located outside of the United States. So, adding international stocks into your portfolio is always a contentious debate. I've heard the claims around these US companies have global reach, so it's the same as having international exposure, or the thoughts on the returns are greater with domestic stocks, all which are fair, but personal finance is personal. So develop an asset allocation that aligns with your risk tolerance and your long-term goals. VXUS is rated a 5 out of 5 for risk for Vanguard, so definitely be mindful of this option. So, last fast facts. The 5-year rated return is 11.13%, which seems low, but is still phenomenal when you look at the 30-year average within the market. A higher expense ratio at 0.08% versus all of the other ETFs is classified as international stocks, with the current price of about $65.55. Note the top holdings here only represent 10% of the entire ETF, which shows you the vast diversity within this fund. Baba, Nestle, Samsung, and Toyota are probably familiar brands here within this ETF. Today, we do own international stocks within our portfolio, but it represents about 1 to 2% of our total portfolio as of right now. But share your favorite ETFs in case I've missed one. I know that there are many other great options, especially sector or industry-based ETFs that I probably missed. But you know the saying, the best time to plant a tree was 20 years ago and the second best time is now, and the same goes for investing in my opinion. Of course, we wish we would have invested more 1 year ago, 10 years ago, 20 years ago, and so forth, but no one can change the past. But we can definitely change the future. So start investing now. And if you are a parent who has a working teenager, get them started in investing as well. I'm working on an UTMA brokerage account video for later this week or next week, but I wish we had opened a Roth IRA for my son. He was working as a model for almost 2 years and had earned income, and we didn't open a Roth for him. Shame on me. ETFs are a great way to get your kids or yourself started on building wealth long term. Now, if you made it this far, thank you so much for watching. But don't forget to like, comment, and subscribe below. Until next time.